In Spiceland Chapter 4, we're going to examine internal controls. Internal control are the methods and measures designed to improve the accuracy and reliability of our accounting records and safeguard the company's physical assets from theft. We're going to focus primarily on cash. Cash, as reported on the balance sheet, includes currency as well as balances in our checking and savings accounts and other cash equivalents. Some examples of cash equivalents include money market funds, certificates of deposits, and treasury bills. These are short-term investments that mature in less than 3 months from the date of purchase, and typically they can be sold at a moment's notice simply by placing a call to a broker or through our online trading account. Because cash is the most liquid of all assets and is easily stolen, maintaining good control over cash is crucial. An important control that we will examine is the bank reconciliation. A bank reconciliation reconciles the balance as reported in our general ledger T account to the amount reported by the bank on the bank statement that we receive. Typical differences between the two relate primarily to timing differences. Timing items where the company has recorded transactions that are not yet reflected on the bank statement, and similarly, items which the bank has recorded but have not been yet recorded in our general ledger. Preparing a bank reconciliation allows us to identify any errors as well as timing differences and report the true and accurate amount of cash in our accounting records. Common examples of timing differences include deposits outstanding. A deposit outstanding is an amount of cash that we have received from a customer and have deposited in the bank, for example in the night depository at the bank, but the amount is not yet reported in our bank statement. In order to properly reconcile account balances, our general ledger is okay because we know we have the cash and have reported it there, but we need to update the bank's records. Another common item are checks outstanding. This is very similar to a deposit outstanding, only the adjustment goes the opposite way. A check outstanding represents cash that has been disbursed to a customer or to another company, but has not yet been reflected on our bank statement. The adjustment that is required is a reduction in the bank's records. Our general ledger account is okay. We know about this transaction and have reported that cash. It is the bank and needs to record an adjustment. Items that the bank knows about, but that we, the company, have not yet made adjustments for. Examples include interest that has been earned by the company and credited to our account by the bank, collections made by the bank on the company's behalf. We often have circumstances where probably not an individual, but another corporate customer make payments directly to the bank for amounts that they owe us. The bank knows about the interest it has credited to our account. The bank knows about amounts other companies have paid directly to our account. We need to update our records to reflect these increases. In this case, the bank's number is okay. It is the company that needs to make a change. Lastly, include reductions that the bank knows about but that the company does not yet know about. These include items like service charges and bad checks from customers. In the case of a bad check from a customer, we've received the cash and we've tried to deposit it in the bank. The bank, however, finds out that the customer really did not have sufficient funds and says, we're not entitled to that. So we have to undo this deposit by making a reduction to our company's records. In the case of a service charge, the bank knows the amount. It has taken that amount out of our account. We need to do likewise. In both cases, we're making a reduction to the general ledger account. So in summary, our bank reconciliation will require 2 categories of adjustments. One are adjustments to the bank balances. Those include increases for deposits outstanding, decreases for checks outstanding. These represent items that we know about at the company level and have accounted for in our general ledger. The timing difference is a lag that the bank has not yet made these adjustments but needs to. Conversely, we will adjust our book balance for things the bank knows about but we have not yet accounted for. Increases include collections that the bank makes on our behalf and interest credited to our account. Reductions include service charges and non-sufficient fund checks. Company errors or bank errors can require adjustments in either direction. There is not a rule of thumb. We have to think through the nature of the error to determine what adjustment has to be made. Let's assume that XYZ Company's general ledger shows a cash balance of $4,583 and the bank statement we receive shows a balance of $7,325. We can't conclude that one or the other is correct without first doing a bank reconciliation. Bank reconciliation requires two columns. Deposits outstanding in the amount of $1,200 represent cash we have received and included in our books, but it has not yet been added to the bank statement. The adjustment is an addition in the bank column. Checks outstanding represent reductions in cash that the company has recorded but have not yet been reflected in the bank balance. Service charges are amounts recorded by the bank but not yet recorded by the company. The update to the company's books is a reduction for the charge levied. And finally, the interest are amounts credited by the bank but not yet recorded in our books. So we will increase our books for the interest earned, and if we have correctly identified all differences, we will be able to reconcile the bank statement to our books. After completing the bank reconciliation, we've identified what the correct balance should be in our general ledger. Notice that the amount currently in our general ledger is $45.83. We need to adjust for these items in the book column. These items we have already accounted for and do not need to record journal entries. We will record the following journal entries. Our cash account before reconciliation has a balance of $45.83. We need to adjust for the items in the book column of our reconciliation statement. We will record the $24 of interest revenue as an increase to cash and the $75 of service fee expense as a reduction in cash. After recording our journal entries, we have correctly updated our T account to the ending balance on the bank reconciliation. As the book covers in some detail, good internal control over cash includes measures such as using a checking account, credit cards, in lieu of actually using paper currency. In all cases, however, it's not practical to avoid using paper currency. Petty cash is currency kept on hand for minor purchases. To establish a petty cash fund, we have to take cash out of our bank account. Here is the journal entry to do so. We're going to create a new account called petty cash for currency that we will keep on hand, and we will reduce our checking account by the $500 that we withdraw. Notice that the overall change in cash is zero. We're simply taking cash from checking and transferring it into currency that we will keep on hand. Our balance sheet value of cash does not change. As we daily operate our business and use the petty cash for a variety of items, we will not record any journal entries. We will wait until the end of the period when we need to replenish the petty cash fund. At the end of the period, we will debit a variety of expense accounts to record the $320 that has been used during the month. We will have entertainment expense, our postage, and repairs expense, and we will credit petty cash that we have used. In this example, $320. In order to replenish the petty cash fund, we will need to debit petty cash as we take more money out of our checking account. In this example, the receipts we had on hand exactly matched the amount of cash that had been spent. In practice, however, we may often find mistakes. There may have been some cash stolen, we may have a receipt missing, and not be able to identify exactly where all cash went. In this situation, we will charge the difference to an account called cash short and over. If, for example, we had $320 of receipts, but found $329 of petty cash missing, we would have to charge $9 to cash short and over, miscellaneous expense account. Or conversely, if we get to the end of the period and we identify $320 of receipts, but only $317 of cash is missing, we will record a credit to cash short and over, which in this case would represent miscellaneous income. We will report cash on two financial statements. It's reported on the balance sheet, where only the ending balance is shown. It is also summarized on the statement of cash flows. There we summarize all increases and decreases. The summary on the statement of cash flows is done in three categories: operating, investing, and financing. We will study the rules for preparing a statement of cash flow later. For now, let's examine only what goes in each category. Let's think about the life cycle of a business. In order to begin business, we need to obtain funds. This is called financing. We need to capitalize our business. Items which go in the financing category include cash transactions designed to raise cash or finance the business. When we obtain loans or issue stock, we are putting cash into the company for future productive use. Once we have cash in the company, we've financed it, we will take that cash and we will acquire productive assets. This constitutes investing in the future of our business. When we acquire long-term assets, once we have the land, building, machinery, and equipment in place, our property, plant, and equipment assets, we will use those assets for day-to-day operations, at which point customers will start giving us cash in exchange for products or services that we render to them. The day-to-day operation of our business are the cash flows which fall into the operating activity category.